Very good day, guys. Lords here once again, market maker, strategy trader, and price action. Guys, I've been getting a lot of questions about the confusion between prices when they are between the 800 and the 200 EMAs. Well, what happens when the prices bounce on the 800 and then they bounce on the 200 EMA at the same time during that same space of the day? So what happened? So let me just quickly explain to you when is it relevant when prices are between the 800 and the 200 EMA. Let's quickly take this example. This is the Euro CAD between the 3rd of October. First thing, guys, always trade off extreme lows and extreme highs. That's the first thing that you do. Once you've managed to pick off an extreme high or low, in this case we're going to look at this extreme low, it's going to be easier for us to identify a specific entry point when the 50 and the 200 cross. When the 50 and 200 cross. So let's take, for example, guys, here we've discerned that it is at the extreme low, right? So around this area, this is where, if we were to go to the 15-minute chart, we'll see the perfect entry point. There's the neckline. This is a double bottom, and there we see with our TDI we have a buy divergence situation happening there. So let's quickly have a look at the market maker template, which is the 15 minutes, and then we'll see where we can pinpoint exactly the entry point. There it is. There's the 5200 crossing. The blue box is less than 50 pips, and it's between the 200 and the 800 EMA, which is that blue line over there. So guys, in this instance, when you wake up, prices are around this point over here. So the first thing that you look at this point is you want anything that bounces off the 200 EMA, which is this point right here. Yes, like I was saying, that immediately out of the blue box, first thing you look at is anything that bounces off the 200 EMA, and you are in that trade. So this is basically a first leg. The trade is more viable and stronger if there's a second leg, but in this case it was just an extreme one red candle followed by a full green candle immediately. That is what we call a engulfing pattern or a railroad track, so you are in that trade. So in this case, it's around about that point, the entry that I just showed you, which is that spike over there, which happens to spike off the neckline. So it's a good trade. It went up and it came back for a second test of that. So it gave us two opportunities, and then immediately prices just ran up. So now the question that is, what happens now when we get an M pattern now of the Mayo going down, which is a good question, because now we've got 0.1, 0.2, and we're expecting prices to come tested at 0.3, which it did right there. But now we could have seen this trade going back to this trend line a way bit earlier, because of this setup right there. There's the 5200 EMA crossing, and there's the first hit, and there's the second hit of the Mayo, and this went down a good 50 pips, and this point over here is exactly this spike moving up back here at point C. So we would have taken this trade immediately, closed there, taken it as a sell, and then closed it when it came to test the support trend line. So the support trend line, it was an entry of what I can say a take profit. It was a take profit guidance. So that's how I play the 50, 200 and 800. As you can see, the 200 is between the 800 and it's bouncing off the 200 M, and it's going down back to the support trend line, right over there. So that's how I play the 5200 crossing, EMA crossings, and the target of the blueberry. So guys, write this down, note it. Whenever you at an extreme low, the 50 crosses the 200, first thing you look for is any bounce of the Mayo. Same thing when prices are at the extreme high, the 15,200 cross. First thing that you look for is any bounce of the Mayo going towards the 800 EMA, which is the blueberry, which is this blue line right over here. So relatively, we would like to take